Today we are talking with Kevin Gallagher, the author of Ruling Capital, Emerging Markets and the Re-Regulation of Cross-Border Finance. Welcome to Readara.
Thanks for having me.
Thank you. And this is the second time you're on Readara, and we are very happy to hear more about the second book as well that you have. And the book is about the emerging markets and how the regulations are evolving as we become more and more interconnected society. Give us a little bit of backdrop of what was happening in the emerging market just about 10 years ago when we were going through some severe financial crisis in the late 90s and how things have changed in the last 10, 15 years.
Yeah, sure. Well, some things never change, and the thing that never changes is that global financial markets are fickle, volatile, and unstable. What has really changed is that both emerging economists and policymakers really said and thought that you really can't do anything about it, that the benefits of getting foreign finance into your economy outweigh the cost of some of the instability. But then, as you said, the financial crises in Asia in the late 1990s and Latin America as well, and in some extent the instability that was caused after the U.S. financial crisis, were all in large part a result of cross-border capital flows, meaning dollar-denominated financial flows and derivatives and stocks and bonds that move around the world too quick. They can surge into an economy. But then if something happens, like an election of Donald Trump or a hint that the interest rates are going to go up or a strong dollar, and as quick as the finance goes into a country, it retreats.
Mm-hmm. So the cross-border has its pluses, but also has its negatives, and these small economies, smaller economies rather, or developing economies sometimes, have not that they're not at a depth or for any reason, for that many reasons, not many countries or economies can handle a surge and can also handle that quick collapse as well.
That's for sure. And the International Monetary Fund used to say, therefore, don't do anything about it. But that's really changed. The Brazils of the world, the Paraguays of the world, the South Koreas of the world, and in the past 2 weeks, the Malaysias and Chinas of the world have all seen this phenomenon really accentuate. And the new thinking in economics and even at the International Monetary Fund, which I trace the sort of politics of it during the book, say that it's actually the smart thing to do to have short-term regulations on the inflow of this kind of capital to prevent massive surges. And then if there's a sudden stop or retreat back to more conventional capital markets, that countries should regulate the outflow of that capital. But one of the ways that the massive surges and sudden stops and massive outflows cause instability in a country is when you get a surge, lots of hot money moving into your economy, it makes your exchange rate appreciate because it makes it more scarce. And so actors in the economy think that they can buy a lot of things with it. And one of the things that they do is buy debt because they think that they will have no problem paying dollar-denominated debts back as long as their exchange rate is strong. But after a large surge and a sudden stop, that makes a country's exchange rate depreciate, and then they have to come up with that many dollars to pay the debt. And so there's a lot of emerging markets now that are having big debt problems. After the financial crisis, the United States had very low interest rates. And so financial actors would borrow money very, very cheaply in the United States and speculate on interest rates in Brazil, South Korea, and other places around the world, pushed up their exchange rates. And these countries were also selling China a lot of commodities and growing really fast, which caused even more investment to go into these countries. But as we know, the world's changing right now. China's economy is slowing down a little bit, and the composition of it is shifting more towards consumer goods. And so a lot of these countries that were doing really well selling to China aren't selling as much. There's also been a concern about the U.S. interest rate rising. And so there's a bleeding of capital away from emerging markets back into the United States. And the countries are now seeing a sudden stop. The two biggest examples are China and Malaysia over the past 20 months. China is lost hundreds of billions of dollars of bled from out of the country, and the central bank has put in place a number of regulations that I talk about in the book that helps try to stem that massive outflow to protect their currency and protect financial stability in the country. And Malaysia has done the same just this week.
If you could draw some historical sketch in how the cross-border flows have evolved in the last 30 years, it was not that fashionable or even acceptable to invest beyond the borders of the United States because they were considered risky, they were considered speculative, they were not even worth investing. But slowly, little by little, in the last 3 decades, things have evolved. If you could give us a little bit of overview.
Sure. Of course, the majority of capital flows around the world are from industrialized to industrialized countries. But over the past 30 or so years, portfolio managers have diversified their portfolios into emerging market and developing countries. But because, as you noted, that kind of investment is perceived to be riskier than in the industrialized world, it really only surges to emerging markets when markets in the north are calm. But if there's any kind of hiccup in the north or a hiccup in emerging markets, it's quick to turn around. So I have lots of graphs that just look like huge tidal waves, and the cover of my book is a tidal wave because that's what the investment profile looks like for the emerging markets. You get these massive floods and then these massive droughts. Developing countries need foreign investment for the most part, but you need it to be steady and reliable. You can't just be doing emergency flood control all the time. But what I show in the book is that in the 1990s, or to go back even further, when the International Monetary Fund was set up and John Maynard Keynes and his U.S. negotiating counterparts were putting together the international architecture for all this, they saw it as very important to make sure that countries could regulate capital flows. They saw it very important for a stable trading system. And so we really want open trade, but you want to make sure that countries can regulate capital flows so that there isn't this kind of instability. In both the economics profession and because of interest group pressure, big banks in the United States and Europe wanting to get access to markets in emerging markets. Starting in the 1980s and even more so in the 1990s, the International Monetary Fund almost changed its Articles of Agreement to require countries to open up their countries to capital flows. But then the East Asian financial crisis occurred, which was largely a function of premature liberalization of countries' capital accounts and letting too much of a surge come in. That changed, and in the wake of this financial crisis, the IMF has actually done some cutting-edge research that both theoretically and empirically justifies the regulation or the re-regulation of cross-border capital flows, and has actually come out with a guidance note and now recommends to countries that they should regulate cross-border financial flows, whereas in the 1990s they almost outlawed it.
What a reversal. In the book, in chapter 3, you talk about managing the trilemma to stability-supported growth. What were the trilemmas and not dilemmas? So maybe there were 3 driving forces that you could kind of describe.
Yeah, sure. So the classic dilemma or trilemma is that it's hard for countries to have a floating exchange rate, have control over interest rate policies, and have the open ability to have capital flows in and out of your country. So those are the 3 things, and you can really only have a combination. You can have combinations of 2. You really can't have combinations of others. If you have an open capital account, you don't have a great control over your interest rate. For instance, say Brazil is in a recession like it is now. Well, one of the things a central bank would do in a less globalized world would lower the interest rate to try to expand the economy and get more money out on the street for growth. Well, if you lower the interest rate and have an open capital account, and countries like the United States have a higher interest rate, or there's market sentiment that interest rates will rise, lowering their interest rate might cause investors to borrow money from your country and invest in the United States, and therefore it would cause more capital flight from your country during a recession. So it takes away that tool to try to get growth going in your country again.
And oftentimes, the foreign exchange markets are not very transparent or have some multiple standards. Like, countries like Russia or other Eastern European countries are always punished for their past behavior, or even a slight appearance of a certain preponderance of even the oil prices going down suddenly gets hammered the ruble in other countries as well. And some countries are given a pass, even if they tend to be sometimes violators on a persistent basis. In chapter 4, you talk about very well, let's not get carried away, emerging markets innovations in the wake of crisis. And you were starting to kind of explain that earlier. The emerging markets in many ways are still emerging markets, and things really haven't changed much. And could you also weave into that, what is the politics of re-regulating?
On the national level, you use the word hammered. So many emerging markets have just been so hammered that there's been a financial crisis in the emerging world every 5 to 7 years since the 1970s. And so it's something that's just is stuck in the memory of everybody, and almost everybody has someone that has lost a job related to financial instability, exchange rate instability. I have students from all over the world, and sometimes Americans, because everybody's denominated in our dollar. When I do the economics of exchange rates, they have the difficult time with it, but not somebody from Romania, not somebody from Brazil. They know how to calculate these things all day because they watch them on a minute-by-minute basis. So countries on a national level have experienced so much financial turbulence that they just do all they can to expand the toolkit. And there's been an interesting coalition that has arisen with domestic manufacturers, because domestic manufacturers, as they have grown up in emerging markets, they need exchange rate stability and financial stability in order to sell their products. During a surge, if there's a massive appreciation of your currency and your currency is very expensive, and that happens to happen in the same month when the production of all the laptops that you're creating in your country to sell somewhere else are all done and ready for export, well, they're more expensive than the ones in another country that might not be experiencing the same kind of turbulence. So then you lose all those orders. So not only do you have the short-term hit on financial instability, but you've lost a whole export opportunity. And so in Brazil and in South Korea, and to a certain extent in South Africa, I discuss in my book that there's somewhat of a coalition between financial regulators trying to be more practical and expanding their toolkit, and manufacturing interests who, even though some might see them as fundamentally market-oriented, they are, but these policies are now seen as market-correcting rather than market-distorting, and sometimes the manufacturers know that better than anyone because they are producing things that when they're ready for sale during a market turbulence, they can't sell their product.
Has there been any action, so it's all talk, in bringing more stability? I mean, there's stability and then there's stability. I mean, what kind of ideal stability we can have and what kind of stability we have right now?
There have been efforts after the financial crisis. I mean, in 2008 and 2009, there have been changes to the Basel capital standards at the global level, requiring countries to have more and more stable forms of capital on hand in their banks. There's been, like you said, a lot of lip service that other more historically unconventional measures, such as regulating short-term capital flows, are now fair game. And to a certain extent, those have thus far, and I'll knock on wood as I say this, have thus far prevented another crisis since the financial crisis of 2008, but they have not prevented financial instability. But in early 2013, when the United States started talking about raising its interest rates again, that's the beginning of lots of capital flight from the emerging markets back to the United States, and many countries did manage their exchange rates through that period, did use cross-border capital flows, and they didn't bring stability, but I think they have kept us away from going over the cliff again.
Would you give one or two examples, as you explain in the book about Korea and Brazil or in other countries, that kind of explains what are the challenges these governments or the economies face when they're going through the tidal waves of up and down?
Well, there's a lot of challenges. First of all, you have to make the decision about whether or not you should regulate it. And if you do, you have to identify what is the channel under which the surge is coming. And quite often these days, it's through foreign exchange markets and foreign exchange derivatives markets, which are hard to regulate because they're so globally diverse. Many of them operate in what's called non-deliverable markets that are offshore, which are hard to regulate. And these days, some of the capital flows go through the blockchain and go through Bitcoin, alternative currencies, which we haven't figured out how to regulate either. And so you want to make sure that you're not just playing whack-a-mole. And that's often what happens, is that if you, for instance, in Brazil, they saw that a lot of surge was coming through the stock market in 2010. And so they regulated the stock market inflows to try to shift foreign investment more towards factories and services industries rather than short speculations in their stock market. But you can also buy Brazilian stocks in the U.S. market, and so a lot of investors shifted away from the regulation to go to the U.S. market. So then Brazil started to regulate the U.S. market. And then investors started going through bond markets and foreign exchange derivatives, and Brazil then created some regulations to go there. And we did some statistical analyses of regulations like that in Brazil and regulations like that in South Korea. And we found that they were better than not having them, but they alone, they aren't enough to bring stability. But again, they can prevent the worst from happening. But they have to be part of a larger strategy where countries need core regulations that allocate credit to and allocate and create incentives for credit to go towards places that are for the real economy, that create jobs and create innovation and create real economic activity rather than just move money across regulatory differentials and interest rate differentials around the world. They bring lots of short-term gains to private investors outside of the country, but wreak havoc at home.
These countries, when they are able to change their trading basket or what they export, also have enormous impact on what kind of investors they attract. As we said, FDI, that foreign direct investment that goes into creating real jobs and real economy, rather than a speculative part of the economy. Have you seen any linkages in how governments have done real job in improving their export and import baskets?
Absolutely. China is the number one best example. China didn't allow any of this kind of capital flows into its country in the 1990s and rolled its up, it was fairly buttressed from the East Asian financial crisis. And as China had what's called a closed capital account, they just didn't allow much of this capital flows to go in. And then they created a financial system that favored manufacturing. And so if you were a manufacturer, a foreign manufacturer, so you could have foreign direct investment into manufacturing, but you couldn't speculate in the bond markets and or the stock markets. So if you were a domestic manufacturer or a foreign company, you had to take your profits and reinvest it in the country and reinvest it in those kinds of sectors. This is what economists call the Lewis model. If you have a wage rate that's a little bit stronger than the agricultural wage rate, and put a lot of investment and incentives into manufacturing that creates jobs and long-run economic growth, you can attract people from the countryside to work in these manufacturers. And if you can do that more productively and at a lower wage than other places in the world, which China locked into that for years, you can become a massive export powerhouse. But the key to the success there, to continue to grow those sectors until they're powerhouses, is that you need reinvestment back into those sectors. Now, as investors in those countries were making profits in manufacturing, they might have wanted to diversify the portfolio of those profits, reinvesting some of it in the United States, reinvesting in some of it in some of the other parts of the world. But China's regulations required them to keep most of that profit in China and reinvest it in these Chinese industries. So that not only regulating, not allowing speculative inflows in, only inflows for manufacturing, was a key part in preventing the surges and not allowing investors and domestic companies to take their profits and move them outside of the country is an example of regulating the outflow of capital. And it worked really, really well for a while, but now, once you become that industrialized, you need a richer and deeper financial system, and China's struggling, trying to take one step forward towards some of these reforms to be more industrialized, but also, as we speak, is experiencing the accentuation of these problems they've liberalized their financial system such that, and their exchange rate such that investors are not as excited about China as they were 10 years ago. And now they have the opportunity to take their money out of China. And so there's been, just last month, $70 billion that the Chinese government had to intervene into the economy to try to save its currency because it was depreciating so much due to capital flight. But that's been the model of most of the East Asian countries. Up until the 1990s, South Korea went from a rice-producing country to a global manufacturing powerhouse through, again, targeted policies for industrialization and employment growth, and a relatively heavily regulated external financial systems, again, so that profits in finance were steered into those sectors. And they're a very interesting example of a country that is now industrialized and is largely open to cross-border capital flows, both on the inflow and the outflow side. But during surges and sudden stops, they do get very sophisticated with regulations on the inflow and the outflow of capital.
You start the book with countervailing monetary power, and you also end the book with the last chapter, The Future of Countervailing Monetary Power. And maybe if you can summarize, focusing on how these things are likely to evolve going further.
Sure. On a theoretical level, I developed the concept of countervailing monetary power, and it comes from John Kenneth Galbraith, one of the few economists in the United States who could ever actually not only do great economics, but also write incredibly. And he wrote a book called Countervailing Power, that argues that economies work best when there is countervailing power, where there's a mix between the power of the market and the power of the public, and that if they meet each other in the middle, you get more economic stability. And I took that sort of framework and thought about the concept of monetary power. That there's so much monetary power from U.S. investment and the dollar surging and escaping from these countries, that there needs to be a countervailing force to be able to get this stability. And I talk about that countervailing force both on the economic toolkit perspective and on the sort of political perspective. And what the book shows is that countries can politically motivate through some of the coalitions that I talked to you about to regulate monetary power or these massive capital flows into countries to some success. And then they can also coalesce at the global level, at the G20 and the International Monetary Fund and places like that, to change the policies of those institutions to allow more policy space to regulate at home. The BRICS countries work together quite effectively. Many of them were regulating at home, but they were also a huge force in reshaping International Monetary Fund and later G20 policy to allow those countries to have the policy space to do that work.
Thank you very much for your time. We have been talking with Kevin P. Gallagher, the author of Ruling Capital, Emerging Markets, and the Reregulation of Cross-Border Finance. Please do keep us in mind when you have another fine book for our readers and listeners.
Thank you very much.
Thank you.